So, welcome to the special live stream session with the release of the Consumer Price Index or the latest inflation data for the month of December 2023, which is set to be released in about 10 minutes at 5:30 a.m. Pacific Standard Time or 8:30 a.m. Eastern Standard Time. And many of us investors pay close attention to CPI every month to measure our purchasing power and inflation. And it is a general indication of how our inflation is trending based on the Federal Reserve's monetary policies. And the Federal Reserve has not raised interest rates since July 26, 2023, which maintained the Fed funds rate between 5.25 to 5.5%. So we've been in the high interest rate economy for quite some time now. And this is going to be a short live stream because I have to meet with my clients later on today, but I should have enough time to answer some of the questions if you put them in the live chat. And if you want to catch me in the next live stream, I usually do it every other Wednesday or whenever the Federal Reserve has a meeting or whenever the CPI data comes out. So be sure to subscribe if you haven't done that already. And private payrolls for the month of December came out last week and it beat Wall Street's expectations, which is not necessarily good news for many investors going forward, suspecting that the Fed will pause any interest rate or possibly pausing interest rates or interest rate cuts in 2024. Sorry about that. But anyway, private payrolls grew by 164,000 workers in the month of December 2023. That's just in 1 month, which is trending upwards from 101,000 in November and the 130,000 Wall Street estimates. And leisure and hospitality led the way with over 59,000 jobs added to the sector. The construction sector also contributed 24,000 jobs, while other support businesses added 22,000 jobs. But the earnings growth is decelerating for people staying in their jobs with a 5.4% increase, and job changers saw an 8% increase. While we're seeing many signs of the labor market going back to the pre-pandemic level, we're still seeing a high employment demand in the private sector. And Jerome Powell said this too in the last press conference, that the labor market remains resilient during the high interest rate economy. And he and the Fed are definitely paying attention to the labor report that's about to come out or that came out last week, because it can have an impact on inflation going forward. And last Friday, look at this, the employment data show the unemployment rate remains steady at 3.7% for the month of December after the November report shocked everyone with a sudden decrease in unemployment rate from 3.9% to 3.7%. The U.S. economy added 216,000 jobs in November, which was an increase from 199,000 in the previous month. But the labor force participation rate ticked lower from 62.8% to 62.5% the month prior. And the average weekly hours worked moved down from 34.4 to 34.3. So 2023 ended with a high demand and a strong labor market. And this is why a lot of investors are saying there are many signs of a soft landing with inflation getting to the 2% goal without a recession. And I think the strong labor market is going to delay the Fed to cut interest rates a lot later than what people are anticipating. And the government sector jobs continue to increase. What was it? It says 52,000 in December, and the local government here, it says it's by 37,000, and the federal government added another 7,000 jobs. And healthcare continues to add more jobs by 38,000 in just 1 month, and it's been one of the strongest job sectors in 2023. Construction employment continues to trend up with 17,000. And my wife is in the construction sector in Vegas, and I can tell you that their projects are almost endless, right? And you know what I'm talking about if you live in the Vegas area. And something else I want you to take a look here is the CME Fed Watch Group here. So the Federal Reserve is making its first decision of the year to either raise, hold, or cut interest rates on January 31st, 2024. And as you can see on this chart, most investors are betting on the Fed to hold the interest rates where they are at 5.25 to 5.5%. And I tend to agree with this with the labor markets, where they are. The only reports we're going to get for the rest of January are the PPI report or the producer price index, which measures the average change over time in the selling prices by producers. So remember that CPI is about the consumers and the PPI is about the producers, right? And we're also going to get the retail sales report from the Census Bureau. I believe that's on January 17th. And yeah, that's it. And the Fed will use today's CPI data and tomorrow's PPI data to decide whether they'll cut or hold interest rates on the 31st, unless something major happens between now and the 31st. And take a look at the projection in March here, okay? Because this is really interesting. And as of right now, the market priced in about 68% chance the Fed will cut interest rates by 25 basis points at the March FOMC meeting, and we'll see what happens. But I would side more if the labor market remain probably more with the 28% column here, because if the labor market remains where it is, the Fed could keep the interest rates where they are now. And if you look at the FOMC meeting on May 1st, the market is predicting the Fed will cut interest rates by 50, or I'm sorry, 60 basis points. And that is a significant decrease going from 5.25 to 4.75%. And that's a 60% probability. And I could see this as more of a possibility, right, than the one in March. And I highly doubt that the Fed will do anything if inflation is still lingering around 2.5 or 3%, because they're really determined to get to that 2% level. But they could slowly adjust interest rates by 25 basis points in March and then another 25 basis points in May. What they don't want to do is have that, unemployment rate all of a sudden goes from 3.7 to, let's say, 4% or 4.2. And the earnings season absolutely matters too, and we're in the middle of it right now with all the earnings coming out from corporations, companies, and we're paying attention to that too, and see what where the where the stock market takes us, right? And if you look at June, that would be June 12th for the FOMC meeting. The market is betting the interest rates will be cut to 450, so 4.5 to 4.75%. So that would be the total of 75 basis points from where we are now, with a 59% probability. So what does this mean to us consumers? Excuse me. And most of you watching this video have a high yield savings account or a 1-year CD or 15-month CD. There's not much we can do with a high yield savings account because we just basically ride with the wave, right? If the Fed cuts interest rates, our yield will also drop. But CDs are a little bit different because you can lock in the 1-year rate at 5.25% or 5.5% or higher. The highest I've seen in the CD is probably 5.8%. I haven't seen a 6% one. But so if you have a sizable cash that you want to earn interest on because you're looking to buy a house in 2025 or in the late 2024, or you're looking to make a big purchase next year, then you should consider locking into a CD rate before the Fed starts cutting interest rates. Unless we see another high inflation like we did in 2022, we're probably not going to see a high Fed funds rates like we've been seeing for the last year or so. And something else I want you to take a look here is the Cleveland Fed projections on the CPI for today. Just real quick, the CPI projection year over year is a 3.32% for the projection, which is higher than the month prior at 3.1%. There's also a month over month increase of 0.3%. And the core CPI, which excludes the food and energy index, is projected to decline to about 3.93% and 0.33% month over month increase. This is quite a significant increase for the core CPI. So it should be coming out here. So let me go ahead and pull up Bloomberg here so you guys can take a look. Let's see what Bloomberg has to say. Sure that the audio is working here. Appreciate you.
The inflation data in America about 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.2%. A little lift in this equity market. In the bond market, we are rallying. We're down 3 or 4 basis points on a 2-year to 432. On a 10-year yield, we are lower by 5 basis points to about 398. With the economic data, CPI in America, here's Michael McKee.
Well, it looks like we had a little hotter than we expected. Inflation during the month of December up 0.3%. The forecast was for a 0.2 gain, pushes the year-over-year number up to 3.4% from 3.1% in November. That's not what the Fed or the markets want to see. However, the core rate comes in at 0.3 as expected, which pushes down the year-over-year core number to 3.9% from 4%. So it's basically what we're seeing here is a little bit worse headline and as expected core, and the core is going to matter more than anything else. Index for shelter is what the BLS says contributed most of the rise in December. Energy rose, increases in the electricity index and the gasoline index, which is a bit of a surprise. So I'll look at the rest of this breakdown here, guys, and you can look at whether the market is freaking out over this.
We've got a move, not a freak out. We're negative by, let's call it 0.10% on the S&P 500, 0.1% on the S&P. We're negative on the NASDAQ by, let's say, 0.03%. But the bottom line is we are off the highs.
Yeah, the market is definitely trending down to this reaction.
So yields were lower. NAB higher at the front end by 2 basis points to 4.38. In foreign exchange, the euro turning around. The euro was positive against the dollar. That currency pair is now negative by 0.15%. 109.56 on the euro against the dollar. Mike McKee, it's not just CPI. Got to say jobless claims.
Jobless claims, they continue to be what they were, 202,000. That is down 1,000 from the revised 203 the week before. But at this point, we're still dealing with holiday weeks and holiday adjustments, and that's always an issue. So it does tell you that the labor market is still tight, but we can't put a lot of faith in the exact number. Continuing claims, 1,834,000. That's down from 1,868,000. So a tight labor market. Yeah. Headline prices up a little bit. Core prices on a year-over-year basis going down. I wish you could see McKee as he plows through this data, folks. It's years and years of experience. Mike, I'm not doing that. I got the cliff notes here. And the answers I'm seeing in owner's equivalent rent, blah, 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 month over month, numbers you follow, up 6.3% year over year. Now, we'll have that come out here in a couple hours and see what housing is doing, rental, and all the rest. But are we underestimating that if there's already rates coming down, that maybe there's a rekindling housing boom out there? Is that an uncertainty? There has been a suggestion that could be happening, but that would be too early to get into the CPI right now. It wouldn't show up. We have seen ongoing strength in rents, which has been a reason for seeing ongoing strength in the housing numbers. But at this point, it's more just the fact that housing prices have not moved down very quickly. Here's the rent number. Rent of shelter up 0.3. Up at this point 0.4 after 0.3 the prior month. So rent of shelter, rent goes up, and then owner's equivalent rent is up 0.4 after is up rather 0.5. I knew it was 0.5. I said 4. I don't know why. After 0.4. So we saw the housing numbers go up, and that did not help. Yeah, I'm feeling.
Yeah, the housing numbers. I'm reading it right now, and it's not
It feels like the longest month ever already.
John,
Okay, so
John Farrow, are you surprised at the lack of movement in the bond market?
yeah, I'm gonna go ahead and pause here. I'm gonna actually show you the data, and if you want to read it yourself, you can always just Google search CPI data, and then the first thing you're gonna see is obviously the PDF and whatnot, but it definitely came in way hotter than expected. I thought it was gonna be like around 3.2, maybe 3.3, just meeting that expectation. But people definitely spend a lot more money in the month of December, maybe for the holidays or whatnot. But let's go ahead and do the breakdown, okay? So the headline CPI, as you can read here, at the first paragraph, it says over the last 12 months, the all items index increased 3.4% before seasonal adjustment. Okay, so that's the expectation was 3.2, and so now we're reading at 3.4. Let's see. Shelter was the biggest contributing factor to the rising CPI, and the energy index rose 0.4%. That is very surprising because it has been decreasing over the past 10 or 11 months. And the gasoline index more than offset a decrease in the natural gas. Okay, the food index continues to rise. That's another factor too. People are still spending money on food, and I'm gonna look at the breakdown in a little bit. The index for food at home increased 0.1% over the month, and the index for food away from home rose 0.3%. Oh, wow. Okay, so that I did not see that. All right, so that's the 0.3%. Let's see. Energy, household furnishing and operations, and the index for personal care were among those that decreased over the month. Okay. So core inflation, if you look at, so core inflation would be, the index, not counting food and energy index, that's 3.9%. That is meeting the expectation. So it was 4% in November, and now it's down to 3.9%. So let's take a look here. And the market is not reacting well to that if you're just tuning in. And so take a look at this. So this is how you read it if you've never read this before. This is the summary chart when you go to the labor website. So what you want to pay attention to is December, right? If you look at December 2023, today is, we're in January, but we're reading the report from December because there's a lag of 30 days. If you look at the far right column, that would be the 12 months. So there will be from a year from today or from December to the previous year on the year over year changes. The one under December will be the month over month changes. Okay. So let's take a look here. So food, we went over, that is still increasing, that about 0.2% and 0.3% for the food away from home. Energy, that was unexpected with a 0.4% increase. If you can look at it here, in the previous months, it's been coming down from negative 2.5, negative 2.3. Now it's going up to 0.4%. Let's take a look here. Let's see. Everything else seems flat. New vehicles are going up again by 0.3%, and then the used vehicles are going up by 0.5%. But year over year changes with the new vehicles is still up 1%, and the used vehicles are down 1.3%. Apparel, let's see, that is only up 0.1%, and then shelter 0.5%. And medical care services at 0.7. So this is the PDF version of it. If you scroll down, it's going to tell you how all of these sectors contribute to the total index, the CPI, right? So the consumer price index. And if you look at the food at home, the index for other food at home rose 2.8% over the 12 months ending in December. The indexes for cereals and bakery products and non-alcoholic beverages both increased 2.6%. Man, cereals and bakery products increased 2.6%. Fruits and vegetables rose 0.3%. Dairy products decreased 1.3% over the year. And the meats, poultry, fish, and eggs index fell 0.1%. So that is good news. But if you like eating cereal and some bakery products, they definitely increased over the month. Let's see. And I wonder, this is a joke, by the way, but I wonder if people just kind of stop eating the expensive items at the food, at the grocery store, and they just kind of overbought cereal, and now the cereal is inflating. I don't know. No, it's a joke. Relax, guys. Anyway, let's see. Energy. So the energy index rose 0.4%. It was pretty significant for just a month over month increase. And the gasoline index increased 0.2%. And I wonder if that has any contributing, what's going on in the Middle East is a contributing factor to it. I don't see how in that shorter period of time. I don't think so, but people definitely spend a lot more in December. And I could probably argue that it was during the holidays, right? People were traveling home or whatnot. Let's see. All items less food and energy did rise 0.3%. Did I skip shelter? No, I didn't. Okay, let me take a look here. Don't want to skip shelter. Okay, so medical care index. All right, so motor vehicle insurance, and I've been talking about this every single month. Or we're talking about the vehicle insurance, car insurance. It's increased again by 1.5%. That's 1.5% in 1 month, in the month of December. And that is it's insane because I have Progressive for my auto insurance and my homeowners insurance, and it just keeps going up, and the explanation that I got from them is that the accident rate has increased since 2019, and they're paying for all of these, total vehicles and the houses, just all the damages and the rising costs, and that's why they have to increase the premium. And I've been shopping around car insurance, and I don't, I don't get into any car accidents, knock on wood, right? But my premiums just keep going up. Let me know in the comment section down below if you're dealing with the same thing. But the premium for car insurance, it says right here, is increased by 1.5%. So like when you look at inflation, right? So generally speaking, everybody can say, "Oh yeah, inflation's fine," or some people say, "No, inflation's gotten worse," or it's just kind of where it's at. I think it's really kind of depends on what sector you're paying attention to. If you like, say you live in a super cold area where you're using more heat, right? Is it costing you more to turn the heater on? And is it costing you more to use like AC during the summer? That's one way to look at it. Yeah, it's, the inflation is there. Or you can look and say, all right, so we're trying not to eat out as much, but now the grocery food has gone up over the past month or so. I mean, that's showing that on this inflation report. It has gone up. So, yeah, when people say inflation is fine, it depends on where you look at it. Okay. Okay. So didn't really talk too much about shelter, but it looks like rent has gone up. I can try to look for it here so you don't look at me all scrolling down. But yeah, so it looks like the rent has gone up. I'm sorry. And there's something else. I think it was the mortgage. So rent. Okay, so the index for owner's equivalent rent rose 0.5% over the month. Okay, so that is one significant increase there. And then 0.4% for rent, and lodging away from home index also increased by 0.4%. Wow. Okay. So from November to December, it's increased a lot, and it's not what what Wall Street has expected, right? So why does this matter so much with the with the inflation? Why we have to pay attention to this, right? Because the stock market, they're really pricing in right now. They're probably going to change it now, but they're expecting the Fed to cut interest rates starting in March. I don't think that's happening in March. I think it's more realistic to say maybe in June, maybe August, maybe a couple months before the election. Yeah, I would say probably 2 or 3 months. I just don't see that happening right now. Maybe, if I had to bet, probably June. So the labor markets, if you're just tuning in, I was going through the labor markets earlier, but those uh, the labor market is still hot. Employers are still actively, hiring people. They're still, I think, in certain sectors, right? Government jobs are still hiring, and in medical professionals, they're still looking for more people to work in the hospitals because more baby boomers are retiring, right? And what's the other sector? That was the leisures, hospitality, and government sector. And there was something else that's increasing too. Construction. That's another thing too. They're really the government is definitely spending more money to improve our infrastructure and all that. And so with all of that happening, they are still hiring more people So when people are working, they're going to spend money, right? So when people spend money, our inflation rate kind of stays either where it's at or it increases. Now, we could all argue, again, December was a holiday month. Everybody traveled home, or not everybody, but people do, and people like to eat out, and people like to get more groceries than normal because they're kind of getting all the family together. So that's another argument too. But just looking at the how hot it got from 3.2% expectation to now 3.4%, that is hotter than the normal. Even if if it's only by 3.3%, I would say that's not so bad, but 3.4, that's pretty hot. Okay. So if you ask me if the Fed's gonna cut interest rates based on that, based on what we're seeing today, they're probably not gonna cut any interest rates until at least summertime, until they see that cooling really happening. I mean, we're already seeing a lot of deflationary indications, but that's only in certain sectors, right? But like rent still going up. People are still buying houses with a 7% mortgage rates, and people are still traveling. Speaking of travel, I do want to look at the airlines. I do care about that because transportation was one of them that is really costly. That has been costly. So transportation services, it has increased. Let's see. Okay, so not bad. Transportation services, if you look at the highlights, and if you're just watching it on YouTube, you can actually pinch your mobile app, or on your mobile app, you can just pinch and zoom in on the screen. Okay, so I'm going to stay zoom out so you don't get lightheaded from me doing that. All right, so I'm just going to kind of scroll down here. So transportation services, and it has decreased. That is good. Decreased by negative 0.5%. And it is still increased by 9.7% year over year. Let's see. Motor vehicle insurance is what we just talked about. It's increased by 1.6% month over month. That is 1 month over month. And if you look at the year over year, that is the second number from the bottom. That's 20.3% year over year increase. How insane is that? That is absolutely bananas. All right. 20.3%. Let's look at airline fares. That is the very bottom of that's the bottom line there. Wow, that's decreased by negative 5.4%. So airline fares went down by 5.4% in 1 month, and it is still decreasing by 9.4%. That is actually exciting. We're looking to travel more this year in 2024. I know that airline fares have been moderately expensive over the last year and a half or so, and since COVID and everything, and I think airlines have kind of like the demand has calmed down just a little bit, but the demand for international travel is still there. And I was reading about that the other day. People still want to travel overseas, and I love to travel overseas. I travel at least once a year somewhere overseas. Last year, I went to the Oktoberfest in Germany. That was really fun. And I went to Austria for a week. Went to Salzburg and Vienna. Went to Hallstatt. That was really fun too. Let me know if you've been to Austria. That's really, really good times. So yeah, transportation costs has calmed down a lot. That is good news. But if you look at shelter here, and let me see if I can highlight this. Can I highlight it? Will you let me highlight this? Okay. So there we go. Can you see this okay? All right, cool. So if you look at shelter here, all right, there we go. Rent of primary residence, it has increased by 0.4%. It is up 6.5% year over year. Okay. And then the owner's equivalent rent of residence down here, or right here. Let's see if I can highlight that. Okay. That one is up by 0.5%, and then it's up 6.3% year over year. Okay. So that is the biggest contributing factor to why inflation has increased. The demand of people buying homes is still there, and that is a problem. That is going to be a problem for the Federal Reserve and for the investors kind of going forward. Okay, so let me see. I don't want to give you guys get you guys lightheaded. Want to scroll down. And I did mention that in the live stream earlier that cereals have gone up. You know why I found cereals? Cereals and cereal products have increased. Wait, hold on. Cereals and bakery products have increased by 2.6% in 1 month. Holy cow, guys. Stop buying cereals. They're getting too expensive. Look at bread. Wow. Oh, you know what? That is the year over year. I'm sorry. That's not a month over month changes. That is a year over year changes. Still going up by a lot. Crackers, bread, it's gone up by 7.7%. Wow. Cupcakes, 2.6. I'm gonna have to tell my daughter to stop buying cupcakes. Okay, let me take a look here. And then the month over month changes. Let's see. Okay, those are looking pretty good. They're okay. If you like beef, it's gone down by negative 0.7%. That's good. If you like ground beef, beef steaks gone up by 1.4%. Eggs. Remember all those memes about the eggs? Holy cow, it's gone up. What happened? What happened? Holy cow. Is that real? You guys see that? Eggs. The one on the right, that's 8.9% month over month increase, right? Am I looking at the right thing? Yeah, November 2023 to December 2023, eggs went up by 8.9%. And the previous month, it was 0.1, and the previous month was 2.2. And the one before that, well, okay. Holy cow, man. I mean, it's gone down by 23.8% year over year, but 8.9% in 1 month is ridiculous. For eggs, stop buying eggs, guys. I like them. Let's see, milk, fruits and veggies. Veggies are okay. Veggies are good for you anyway. Let's see. Candy, gum went up by 0.3%. Coffee keeps going down. That's good, right? Negative 1.4. Ooh. Yeah. Okay. Snacks, food away from home. All right. Okay. That's not too bad. Let me take a look and see what Bloomberg's saying. Actually, they're not saying much anymore. I think they're all kind of like meh. But the S&P 500 is flat. The market will be open in about 40 minutes. The market is flat right now. And I think they're just kind of trying to figure out what to do with this, right? With this data. And I definitely want to dig a little more deeper into this. I mean, you're more than welcome to, read more into it. It gets a little nerdy with all the numbers, but you can always look from, these items like expenditure and bicycles. They get really, really detailed of all this. Okay. Something else that I didn't notice though, I did want to go over this article real quick. California's economy shows danger signs. Is a recession coming in 2024? Okay. That is really interesting. I do want to go over that a little bit. Oh, by the way, I don't know if I told you guys, but I don't think I did. I just partnered with YNAB, that the budgeting app. You need a budget. I don't know if you guys ever budget with the YNAB. It's an awesome budgeting app, and just partner with them. So I'm in the next live stream or in the future videos. I'm always going to include it, and I believe I have that link in the description below if you do want to sign up to get the free trial. It is a great budgeting app, and I'm sure you guys noticed too. Mint.com is going to be gone. I think they're already gone, and YNAB is pretty much snatching up all the customers right now, and It's a great budgeting app. I do like them. Been using it for a while, but the link will be in the description. So, yeah, so this is the other article that I was discussing with other finance nerds. California is in trouble, and they're talking about how they got the $32 billion deficit in 2023, and the governor Newsom, right? They're still kind of going over what they're spending the most, and I did a detailed budget breakdown of the California spending probably like a year and a half ago during the live stream, and they're spending on healthcare the most, public healthcare. Okay, like a lot of money on them. And when there's a deficit, obviously what that means is that they're spending more than they have, right? So they're borrowing from the federal government as well to meet their spending goals. But for 2024 to 2025, their flat revenue from personal income, corporate, and sales taxes for the next 3 years are projected at $68 billion deficit for the 2024-2025 budget. And the state's unemployment rate was 4.2% that started the year, and now it's at 4.8% in October. So if you're watching this from California, let me know how it is and how accurate this may be. So the nation's right now, the U.S. unemployment rate is at 3.7%. Actually, I know it says 3.9, but it's actually 3.7. Oh, I'm sorry, that's 3.9% from October. So that's interesting how California's unemployment rate just continues to climb, and the job growth has slowed. And even in the technology sector, and I can see that probably happening in the future too, as more companies start to transition to AI. And the tech industry, a lot of tech companies have moved away from the Silicon Valley. And I grew up in Fremont, California. It's not too far from San Jose. My gosh, almost 20 years ago now. And I remember how the tech sector, the tech industry was just, it was thriving, right? And then we went through the dot-com bubble for 2001. Well, actually before that, it was like end of 1999 and 2000, 2001. And yeah, we went through that, the recession, and then came back up. I moved away from California back in 2004. But right now they're talking about how the high wage jobs are going away in California, and a lot of workers got laid off over the year. So let's see. The problems they're having is that California is spending way too much money, and for the revenue that they're getting, and California is still a really good state, right? It's a great state, awesome weather and all that, but they're really having trouble bringing the money in. And the reason is they have companies moving away from California. And I think the other reason, this is my opinion, is that a lot of companies are switching to AI, where they can just hire people to do 2 or 3 jobs and have the AI do the rest of it. That's just the reality that people will have to face in the future. Is a lot of the tech companies are going to have they're going to start relying on the AI. Let's see. The other one was from this article. I thought it was interesting. Yeah, California's population has declined. And I know this, and I live in Vegas because a lot of Californians moved to Vegas, right? And it's actually, pissing a lot of people off in Vegas because our housing prices keep going up. A lot of Californians come to Vegas and just buy houses with cash. You could buy like a 3,000 square foot house in Vegas for $700,000, and then people from California just have cash to pay for that, and it's kind of like driving a lot of the prices up. But California population, it has decreased by 700,000 people in just 1 year. That was from 2022, and some of the major issues that we're talking about here was okay. So yeah, so more layoffs, slowdowns in the tech industry, and IPOs. I'm not sure if IPOs will have like the big contributing factor to it, but definitely just kind of like companies moving out of California, people moving out of California due to the rising cost. And there, at the same time, there was another article saying that the California is looking to raise state income tax. I'm like, I'm not sure that's going to solve the problem, right? That's probably going to end up driving more people away from California and not wanting to stay there. So that's just my honest opinion as a ex-California myself from 20 years ago. I haven't lived in California in like 20 years. I don't think I'll ever go back. I'll be honest with you. That's just the reality. And I'm sorry that people are going through this, but it would be interesting to see where the California economy goes. And they're talking about Gavin Newsom possibly running for office. Okay, but I'd like to see him maybe manage to stay a little bit better. That's just my opinion, my humble opinion. Anyway, okay, so I don't have anything else from here. Oh yeah, so lastly, I just recently partnered with YNAB, and you need a budget. So if you go to my link in the description, you get a free trial for the budgeting app. It is an awesome budgeting app, and just check it out when you can. And I'll keep looking at the inflation data and see where it goes. But kind of going back to the CME Fed Watch tool, just real quick before I have to go, let me see if this has been updated. Let me refresh this actually. Yeah. If you look at the yeah, there's like a 98% chance that the Fed is not going to cut interest rates in January, which is in 2 weeks. Actually, it's in 3 weeks. And then in March, yeah, it doesn't look like people are looking. There's a 61% chance that the Fed will cut interest rates, only by 25 basis points though. But if I were a betting man, I would say probably going to be June or July, around this time frame. Okay. If I had to guess, it's probably going to be in June, and I would say they're probably going to cut it by 25 basis points. The problem with the shelter in inflation, the index that we just saw, is that it is rising, still rising, right? If the Fed cuts interest rates next month, that's going to drive people to get more mortgages out. And that becomes a problem too, because when people take out a mortgage and buy a house, what does inflation do? It keeps going up, right? So that does become a problem. But anyway, appreciate you guys tuning in. Hopefully we get a better data next month. And, if not, we'll just keep watching and see where it goes. And I will be back for live streaming in about 2 weeks. So just keep tuning in. I really appreciate you guys being here. With that said, see you next time.